In this video, we are going to backtest a trading strategy that is based on the simple moving average indicator. Our goal will be to avoid trading when the stock is trending down and only to take trades when the stock is trending up, such as in a situation like this. We are going to code this up in Python. We're going to compare the returns of this trading strategy to the buy and hold strategy and also to trading randomly. And we will show the Python code. As always, the download link of this notebook is in the description. And we will learn how to make this strategy work and what are the pitfalls of this strategy. So we will start by looking at our previous video where we looked at a random trading strategy and we built this backtesting library which we tested using the simplest strategy, which is the random trading strategy. So let's first understand what happened when we tested out our random trading strategy. The green circles are where we entered a trade, such as one here, and the red circles indicate where we exited the trade, such as here. So in this strategy, we are taking our trades randomly, but we are taking only one trade at a time. And sometimes we were able to exit at a profit, such as in the first trade that I showed here, but sometimes we had to exit at a loss. So for example, we took a trade here, and then we exited at a loss here. And the cases where we exited at a loss are marked by this cross sign. So if you look closely at this set of random trades, you will notice one common pattern. There was a time period here where the stock was trending down in general, and then these trades were all losing. So if you concentrate on this area where the stock was trending down in general, you can see that our trades were all losing trades. And the reason is we put an equidistant take profit and stop loss, and we were hitting our stop loss when before our take profit hit during the period when the stock was going down. But if you look at the subsequent period here, the stock was going up, and here we were hitting our take profit before we went to the stop loss. And so this is a comment that I also got in a previous video where I was talking about trading randomly and depending on sort of the mean reversion time in order to make profits. And someone commented that in order to do that, the stock has to sort of be on an uptrend, which is a very valid comment. And I had promised to sort of look at that in a follow-up video. And this is basically that follow-up video. So now let's look at how we can actually identify the period in time when the stock is on an uptrend. So the way we do that is basically the simplest possible way to do it, which is to calculate the simple moving average indicator. And as you can see, when the stock goes on a downtrend in this region here, the price moves below the simple moving average indicator. And in the other hand, when the stock sort of is on the uptrend, which is in this region here, the price is above the simple moving average indicator. So we are going to use this simple sort of rule of thumb in order to modify our random trades. We are still going to take our trades randomly, but we're going to take those trades randomly when the price is above the moving average indicator. And let's see what happens when we do that. So now this is the result of what happens when we do that. And as you can see, we have been able to avoid most of the trades in this particular region when the stock is going down. And basically, we again take sort of similar random winning trades when the stock is going up. And we have been able to avoid some of the losses during the downtrend of the stock. So that is our rule, is to sort of take trades randomly, but when our price is above the simple moving average indicator. So now let's go and look at how to code this up in Python. If you have I will link my video where I described the way to sort of I built the backtesting library, and please see that video in detail to see the nitty-gritties of my backtesting library. But here I will sort of describe that in a very briefly and talk more about the strategy itself. And so we start by getting some data. The data we get is the usual sort of Bitcoin data, which is a 5-minute period. So this is, as you can see, the interval is 5 minutes between successive data points, and then we take sort of the first 1,000 data points to test out this strategy. So first we test out a random strategy where we start with a cash of 70,000, which should allow us to buy 1 Bitcoin at a time. That's the general idea. And then I run the backtest. I have this run backtest and show stats. And as you can see here, when I sort of visualize the backtest using the library, which I described here before, you can see this result where I lose some of these trades here, and then I keep winning when the stock goes up. So now let's try to enter based on the moving average. So first we calculate the moving average. We calculate the 100-day moving average here. But we can test out with different other sort of moving averages as well. And we use the mid, which is the average of the open and the close, in order to calculate the moving average. That's a choice we make. And we observe that in the first few data points, we don't have the moving average. We only have it after like 100, like the top 100 data points. And as you can see, it's sort of not defined here. And then we plot the moving average, as I showed you in the previous graphics. And then we define a separate strategy, which is what we call the random SMA strategy. And I will show you the code to define the strategy, which defines the strategy. But then we again run the backtest. And we see that when we show the stats, we see that we have improved on the win rate here. So when we were entering completely randomly, our win rate was, so we won 10 and we lost sort of 5 trades, and our win rate was like 66%. We've improved that to 69%, although our returns are very similar. We've taken less trades here because we decided not to take trades in this particular region when the stock was going down. So now we take sort of no trades here. You will notice though that we lost 1 trade here because this is a lagging indicator, and when we entered this trade, we did not know that the stock is going to go down. But once it started going down, now we sort of stopped taking any more random trades here. So let's go up and discuss on how we decided the entry and look at the code. So if we look at I'll just briefly describe the backtesting library, and you can look up the video which talks about how to code up the backtesting library. But basically, this is the main function, which is run test, and it iterates through all the rows of the data frame, and it calls the run function of the defined strategy. So the strategy could be a random strategy or what we call the random SMA strategy here. So in the case of the random strategy, the run function, what it tries to do is, first of all, if there are any open trades, it tries to close a trade. And basically to try to close means try to close checks if we have reached the take profit or the stop loss, and then it sort of closes the trade. And then the random strategy says it generates a random variable, which is a Bernoulli random variable, takes 0 or 1, and if the random variable is 1, it decides to buy buy 1 Bitcoin with the set sort of profit and percentage profit and a stop loss at 1%. Now, the modification in the random SMA strategy is that when we decide on whether to enter the trade, we have the current RV, which is the random variable, which we generate simply as before, 0 or 1, and then we generate another Boolean which says whether the high of the current candle is above the SMA of that particular row in the data frame. So only if these two are true, only if the high of the current candle is above the SMA and our random variable is 1, we decide to buy using the exact same sort of profit percentage and stop loss. So that is the only small change that we make. And also, it's sort of a more academic approach to trading, I will say, where we start with a completely random strategy, and then we sort of try to slowly tweak that methodology to see if we make substantial improvements on that random over that random sort of strategy. So did we make substantial improvements? So when we looked at this small data frame, our returns were almost similar. Win rate 66.66%, returns is like 4%. And with the SMA strategy, the returns is slightly more and the win rate is slightly more, but it's not significantly high. So one reason is because we are testing the strategy over a very small period of time, and there are only a few trades, like maybe like two or three trades that we sort of bad trades we were able to eliminate because of this strategy. How about we look at a larger time frame? So we looked at a much larger time frame, so like 5,000 data points here. And again, we calculated the 100-day rolling average. So this is a case where the buy and hold is like -8%, and then the random strategy has a return that's even worse than the buy and hold. Now let's see what the random SMA strategy does. It actually does way better than the buy and hold return. Although the returns are all negative because this was sort of probably a period where the stock trended down a lot. But as you can clearly see, the random strategy was doing very poorly. It was not even beating the buy and hold, whereas the SMA strategy was able to clearly beat the buy and hold by a very large amount of, a very large percentage. And the win rate was 50% as opposed to 44.5%, which clearly shows that this strategy is sort of better than randomly taking trades. And this is sort of something I want to point out, is that as we sort of build on different strategies, our approach will be to start from the random strategy and ask and sort of build together small but simple building blocks over the random strategy to see how we can improve our strategy and get to sort of the best possible strategy that we can. But again, all strategies are dependent on the regime that the stock is in, the particular instrument that we are trying to trade, and so that is something to always think about. But thank you for watching this video. Please like and subscribe if you like the content here, so that I can keep making more videos on backtesting Python's trading strategies. And what we learned from this exercise here is that by adding the simple moving average to our random strategy, we were able to significantly beat both buy and hold and the random strategy. Thank you.